Okay, so how exactly does a major outdoor brand navigate shifting tariffs, a 14% drop in sales, and a completely chaotic retail market, yet still manage to come out the other side with absolutely zero debt and a pipeline packed full of smart technology? I know, it sounds like a paradox, but that's exactly what we're looking at today. Welcome to this explainer, where we are unpacking the fiscal 2026 financial results of American outdoor brands. We're going to dive deep into their filings to see exactly what's keeping them so resilient.
Here's how we're going to break it all down. First, the fiscal 2026 financial highlights. Then, unpacking that initial sales decline. Third, the innovation driving their business. Fourth, their balance sheet's health. And finally, their outlook for 2027.
All right, let's jump straight into Part 1, Fiscal 2026 Financial Highlights. Right off the bat, you're hit with a top-line shocker. We're looking at a 14.3% drop in net sales compared to the prior year. Now, you know as well as I do, in the retail and manufacturing world, a double-digit decline is essentially a flashing red light. It's the kind of metric that immediately grabs your attention and demands answers, right? Because whenever you evaluate a company, top-line revenue really sets the baseline for the entire conversation. And starting in double-digit negative territory is, well, it's a hurdle for sure.
Just looking at the raw data, that's a steep plunge from $222.3 million in fiscal 2025 down to $190.5 million in fiscal 2026, a $31.8 million decrease year over year. Honestly, if you stopped reading the financial report right here, you might assume the business was in total freefall, a classic case of a brand just losing its footing in a tough macro environment.
But financial filings rarely give you the whole story on page 1. To really gauge the health of American outdoor brands, we've got to look past those scary headlines and uncover the market dynamics playing out behind the scenes. We need to peel back the layers of this onion to understand the specific supply chain behaviors and retail shifts that actually cause this sudden change.
Which brings us to Part 2, unpacking the sales decline. Let's look at the real narrative here.
So, the story changes completely when you factor in this number, $10 million in pulled forward orders. Facing massive uncertainty over changing tariff policies, retailers basically panicked. Anticipating huge price hikes, they actively accelerated $10 million worth of orders from the beginning of fiscal 2026, yanking them into the final weeks of fiscal 2025. So this anomaly artificially inflated the previous year's numbers while simultaneously deflating the current year's numbers. When you take that $10 million and shift it back to where it organically belonged in the demand cycle, boom, the situation looks vastly different. That scary 14.3% drop, it shrinks drastically down to a much more manageable adjusted decline of just 5.4%. It completely flips the narrative from a structural crisis to a slight, understandable contraction.
And here's the kicker. Point-of-sale consumer demand, meaning what people are actually buying at the cash register, went up. Point-of-sale results in their outdoor lifestyle category jumped 7%, and shooting sports ticked up 1%. This proves the underlying brands are still strongly resonating with consumers. Wholesale shipments to retailers might have fluctuated due to tariff fears, but the core customer base hasn't gone anywhere.
Part 3. Innovation driving the business. Let's talk about how they are keeping those customers so engaged.
CEO Brian Murphy hit the nail on the head here, highlighting their massive pivot into building connected ecosystems driven by smart products. They aren't just stamping out traditional hardware anymore, they're creating integrated, tech-forward experiences for modern enthusiasts. This is huge because it transitions American outdoor brands from just a standard manufacturer into a tech-adjacent lifestyle brand.
And you know, this isn't just executive buzzword bingo meant to keep shareholders happy. The data absolutely backs it up. New products generated over 29% of their entire fiscal 2026 net sales. Let that sink in. Nearly a third of their revenue came from items that didn't even exist in their catalog relatively recently. That's a massive testament to their R&D engine. They are quite literally gamifying the outdoors. Under the Caldwell brand, they've built the Claycopter and Claymore Connect, which feature these revolutionary wireless ground launchers. Just imagine being able to sync and control up to 10 clay launchers right from an app on your smartphone. And on the fishing side, they partnered their Bubba brand with Major League Fishing to introduce Score Tracker Live. They use smart fish scales to create real-time digital tournament leaderboards. They're completely redefining what outdoor gear even looks like.
All right, moving on to Part 4, Balance Sheet Financial Health.
Looking under the hood, the foundation here is pristine.
They ended the year with $21.4 million in cash. They also aggressively executed a $9.5 million reduction in their inventory, bringing it down to $91.8 million, freeing up cash that was just sitting around as unsold product. And the absolute standout metric for me? Zero debt. Operating with zero debt in an era of high interest rates is an immense strategic advantage.
To really hammer home their financial discipline, they didn't just sit on that cash either. They took over $5.1 million of it and repurchased their own common stock throughout the year. Buying back over 2.8 million shares shows serious confidence from management in the long-term value of their own company.
Plus, despite all the supply chain headaches, the tariff chaos, and a really tough retail market, they defended their profit margins like champions. They maintained a solid gross margin of 44.7%, which is actually a slight uptick from the prior year. Protecting your margins during a revenue dip, that's the true hallmark of an agile, disciplined company. They didn't resort to desperate discounting just to move boxes.
That incredible footing leads us perfectly into Part 5, their outlook for fiscal 2027. Armed with leaner inventory and a super robust innovation pipeline, management is projecting a really strong rebound. They are expecting a 5 to 10% jump in net sales for fiscal 2027, eyeing revenue between $200 million and $210 million. After all the tariff-induced turbulence of the past year, they are officially signaling a very confident return to top-line growth.
But wait, it gets better. Their adjusted EBITDA, which is a great measure of their core operating profitability, is expected to absolutely surge. They're guiding for it to hit between 6.5% and 7.5% of net sales next year. At the midpoint, we're talking about a massive 40% increase in operating profit over the prior year. That shift toward high-tech, smart ecosystems, it's paying off big time right on the bottom line.
So we'll leave you with this final thought in today's explainer. Armed with a pristine balance sheet featuring zero debt, plenty of cash on hand, and a pipeline filled with smart, gamified tech that consumers are actively responding to, is American Outdoor Brands positioned to completely dominate their market's next growth cycle? Honestly, the numbers suggest they've built the absolute perfect foundation to scale that next peak.